Are you considering if an FHA loan is right for you and what the fees are? What's your monthly payment going to be with mortgage insurance? So today, I'm going to reveal some costs that you need to know about on FHA loans, mortgage insurance premiums, which are not only monthly, but also an upfront premium. So this video is going to explain all of it so that you can make the best decision for yourself. My name is Jennifer Hernandez. I've been a loan officer since 1995. I'll save you the math. It's a lot of years, and I've closed thousands of loans. I'm really passionate about bringing real facts, no BS to homeowners. So let's get started. First off, I love FHA loans. FHA loans have a lot of benefits for buyers, so be sure after this to check resources down in the description and watch our overview video about FHA loans 2023. So mortgage insurance is, well, actually on FHA loans, FHA, Federal Housing Administration, was created back in the Great Depression, a little fun fact for you, so that home ownership could be more attainable to people. And you can put as little as 3.5% down, but what was also created is something called a mortgage insurance premium. Now, way back then in the 30s, it was only on FHA loans. Mortgage insurance didn't get created for conventional loans until the 1980s, but we're not going to talk about conventional loans today. We're going to stick with FHA. We're talking about a mortgage insurance premium. That's what it's called. And it comes to you in two different ways. So the first type of mortgage insurance is an upfront premium. So at the time of the making of this video in 2023, the current upfront mortgage insurance premium is 1.75%. So we're going to go over how to calculate that, and then we're going to go over the monthly premium, which at this time in 2023 has been lowered in the recent months to 0.55%. And that's a big win for FHA to make it more attainable for buyers to have a better monthly payment. So first, let's calculate mortgage insurance premium, upfront premium. So let's say in this example that your loan amount is $300,000. Now, this is not your sales price. So your sales price would be a little higher than that. Remember, on FHA loans, your down payment is 3.5%. So let's say after you make your down payment, the loan amount that's left over is the $300,000. So you would take $300,000, times it by 1.75%, and that equates to $5,250. Now that $5,250 is added to your $300,000 loan. The reason is because FHA came up with this strategy to really spread the cost of the mortgage insurance over the 30 years so that it wasn't as much of a burden on homeowners on a monthly basis. So that $5,250 added to your loan, and it is now a loan amount of $305,250. Now, I do get asked a lot, Jennifer, can we buy ourselves out of the FHA premium? The answer is no. It's rolled into your loan amount. You actually cannot pay that up front. And I'll be honest with you, most FHA buyers can't afford to pay that up front, so it's rolled into the loan. And it really pushes up your payment, really not that much. So it's really cost effective to do it monthly over 30 years rather than upfront. Now, another important thing to note before we hop over to the monthly premium calculation is that if you refinance or sell within a 3-year period, you might be entitled to a refund of unused upfront premium. Now, it's a sliding scale. You can find out more information on it in the description below. I've put a link to a resource where you can read all about it. But at the time of refinance, which a lot of people will be refinancing in a few years, you might be able to recover and reduce your loan payoff by that unused premium portion. So now we're going to hop over to the monthly mortgage insurance premium, or MIP for short. So this is the one that's really going to affect you on a monthly basis. It's part of your payment, so you'll pay it monthly along with principal, interest, taxes, and insurance. So this is calculated by taking your loan amount. Again, we're going to take the same $300,000 loan that we used in the other example, and the monthly premium is equivalent to 0.55%. So we're going to take $300,000, we're going to times it by 0.55%, and that equals $1,650. Now there's one more calculation. You take that annual premium and you divide it by 12 months. So you divide it by 12, and that gives us $137.50. So as your loan amount goes up above $300,000, your premium, or lower, if your loan amount goes lower, that calculation will go up or down depending on your loan amount. Now make sure you know that in certain states, or every state, every area has a different FHA limit. So you want to, again, make sure you watch my video that we'll put in the resources, and we'll actually put it in the title card above, of FHA loans, so you know the current limits and how FHA loans work. So back to the monthly premium. One side note that I'd love to mention is that this premium monthly on FHA, whether it's upfront or monthly, does not depend on your credit score. So you can have a 620 or you can have an 800, and the mortgage premium, the mortgage insurance, is the same. Now something that does give you a discount is if you put 10% down or more, and you do either a 15 or 30-year loan, it doesn't matter, your monthly premium amount will go to 0.50%. So there is a little bit of savings there. The thing that we're going to end with this video on, the last thing we're going to cover, so you want to hang on, is can I cancel my mortgage insurance premium? Is it cancelable? Like on the conventional loans, it is at 80% loan to value. So here are some facts that you need to know. There's 3 ways to cancel the mortgage insurance on an FHA loan. Number 1 is you could sell. When you sell, you're not going to have to pay that anymore. Number 2 is you could refinance. So when you refinance, hopefully your house will have appreciated. You'll be below 80% loan to value of the new appraised value, and hopefully you'll be able to qualify for a conventional loan. So qualifying for a conventional loan, we'll also put resources down below of conventional loans, so you know what that criteria is. But when you refinance, if you qualify for a conventional loan, you will not have to pay mortgage insurance. So the third way that a lot of people can waive the insurance is by time spent in the house and your initial down payment. So if you put at the time of purchase, if you put 10% or more down, then your PMI will automatically cancel in year 11 after 132 payments. Now a sidebar is that if you put less than 10% down, that PMI, that mortgage insurance premium, actually is not cancelable. You will have to pay it for the life of the loan as long as you live in the house. So for example, if you sell the house in year 7, you just stop paying the insurance. Nothing is going to accelerate. They're not going to charge you the future years that you haven't lived in the house at all. So you would just sell the loan and it would go away. So this is a wrap. Please, if you're enjoying videos like this, stick around, watch another one of our videos. We've actually got after here how to buy a house, the home buying process A to Z. Talk to you soon.